Hi guys, it's Miss Becker. Um, we want to start talking about chapter 26. We're also going to talk about chapter 27. We're going to talk about them together. Um, for chapter 26, this is where most of the content will be, and then 27 will be pretty brief. Chapter 26, as you can see, it discusses savings, investment, and the financial system. So basically what we're looking at here is when you graduate from college and you want to start your own business, you have to take a look at what the costs are to start your business. Um, then you have to try to figure out, well, how am I going to get started? How am I going to build capital to be able to produce the goods and services that I need to produce in order to be successful? And when looking at that, we say, well, how can we start up our business financially? And there's a couple different options. Either, you've saved money over the years, or maybe you ended up getting scholarships to college, so your parents gave you your college money for you to do whatever you want when you graduate. Maybe family and friends invested in your business or gave you money to borrow, or you may have taken out some loans. Okay, obviously, loans is what we don't want to do. Perfect example would be for the situation we're in now. If you have loans you have to pay on your business and your business is closed due to the situation we're in with COVID-19, then that would obviously make you suffer financially, your business suffer. Okay. So first of all, let's just talk about what the financial system is. The financial system is a bunch of institutions that help match one person's savings to another person's investments. Now, we talked about that a little bit briefly. And what we mean by that is when you put your money in the bank to save it, we've talked about how your money does not sit there, right? It gets loaned back out to other people. So you deposit your money into the bank and you receive interest on your money, so you're getting paid on it, but your money then gets loaned out to somebody else who they then pay the bank interest. Part of that goes towards the interest that you're making on your money being loaned out, and also part of that interest that the person that borrowed the money, part of that interest goes towards the banks themselves so that they can also make money. So savings and investment are the key ingredients to long-term economic growth, right? Which is why the government, like they are now, gets involved a lot when there's some kind of crisis or if the GDP is plummeting. That's why the government gets involved and sets policies and laws that help with interest rates and whatnot. So the more resources that are available for investing in capital will raise productivity, which in turn raises our standard of living. Okay. So the types of financial markets that we have is we're going to look at banks. Obviously, you're probably most familiar with banks. That's where we save our money. That's where we get most of our loans from. But then we also have the bond market and the stock market. Okay, and we're going to talk about the differences between those. Okay, so the bond market. So when we talk about the bond market, we're talking about it being one of the financial intermediaries or ways for a person to invest money and to save money. Okay, so a bond is essentially a certificate of indebtedness. That's the definition, certificate of indebtedness. What that means is when a company needs money, for example, or if a school district needs money. I think we've actually talked about this because our district just did a major construction project, right? They were issued a bond through the government. That means they were issued money that they could use to reconstruct the school district, whatever it is around the district they were doing. But then they have to pay that money back on the day it matures. That means when you borrow this money on its maturity date, whether it's 3 months, 3 years, or 15 years from now, that date is when you pay back the money you borrowed plus the interest. Okay, so that's what a bond is. A bond has terms, which means it means to all be paid back on the day that it matures. Okay, and that's what term means. Term is however long you have that bond until it matures. It could be a long-term bond. It could be a short-term bond. Okay. Are bonds risky? Of course they're risky, because God forbid the maturity date comes for a bond that you issued out to somebody for their business, and that business has since gone bankrupt. That means you will not get your money. Okay. Is it the riskier of the two? No. Stocks are more risky, which we'll talk about in a couple minutes. But it's still risky, of course, to issue a bond because you're still putting your money out there for a business that's uncertain. Okay. Um, Tax treatment. So the taxes are a little bit different. Interest on a bond is taxable income. So if you issue a bond to somebody and they're paying you interest on that bond, then you do have to count that as income, as profit that you're making. Okay. And then municipal bonds are a little different. Those are local and government bonds. So like if the town of Montgomery needed to repair one of their roadways and they go for a bond, it would be called a municipal bond. Okay, so stock market. So I've already said that the stock market is definitely more risky than the bond market because the stock market, obviously, there's no control. Look what's happened recently. The stock market has plummeted. People have lost hundreds of thousands of dollars in the stock market right now. Hopefully, they're not planning on getting their money out of the stock market anytime soon because then it will have time to rebuild. But as of right now, everybody that has their money in the stock market is losing a lot of money. I have an activity for you guys to work on. It's, it seems like a lot of work because I put 2 chapters together, but we're still taking the full 2 weeks, actually a little bit more than 2 weeks to do it. We'll take whatever time we need, but I want you guys to do that that stock activity because I want you to look at the Dow Jones and the S&P. I want you to look at just what those things are. We don't get heavy into stocks themselves in macroeconomics, but we need to understand what they are and the differences between stocks and bonds. Okay. So as you know, with stocks, I'm pretty sure that we've talked about this already, but a stock is ownership in a business. So I know a lot of people actually, when this whole crisis started for us, that purchased Disney stock because the value of the stock went down really low. But they know with Disney, it's eventually going to get really high again because everybody, so many people go to Disney, and spend a lot of money there. So the stocks will go up again. So those people that bought ownership in Disney had purchased shares of stock, and they will receive what's called dividends. And dividends is the profit you make from stocks when companies figure out what they've made as far as revenue and they figure out their profits, then the dividends get paid out to each shareholder depending on the number of shares that they purchased. Okay. Okay, so now those were stocks and bonds. Please let me know if you have any questions, guys, okay? Email me, whatever you need to do. Send me a private message, and I'll explain that again. So financial intermediaries, it's important that you know what these are. You already do know what these are, but the technical term is financial intermediaries. These are the actual financial institutions through how we save our money. So one option is through banks. You guys are very aware of what banks are. This is where we deposit our money, withdraw our money, we get loans, we pay back loans, and then there's mutual funds. Mutual funds are institutions that work to sell shares of stock to the public. So if you have, as teachers, we have what's called a 403B. Most of your parents probably have what's called a 401k, and it's a retirement plan that you get. You start out, right when you first start working, you should start a 401k. Even if you only put a little bit, you get to put non-tax money in there. So even if you put $20 a paycheck in there, basically a mutual fund means that this financial institution is taking that $20 and putting it into different shares of stock depending on what you choose. Usually when you start out younger, like in your 20s, you will go into a high risk portfolio, meaning that you're going to put your money into stocks that will make a lot of money quick. Okay, and then as you get older, then they start to move your money around so it's not as risky because obviously they don't want you to lose everything. Okay, so a bank and mutual funds are 2 main ways that people save money. Okay. Um, Sorry. So, and remember that GDP, when we talk about gross domestic product, it's both our income and our output on goods and services. Okay, keep that in mind because that helps us identify when we're just looking at the GDP, rules of banks, the stock markets, the bonds, the mutual funds. They all have identities or characteristics, right? And we know that because we've actually already talked about that when we first started talking about GDP. We talked about how I think it's, yeah, the next slide here. We talked about how GDP equals Y, meaning that's what we're looking for in the end. And we find our GDP by talking about consumption, which was consumer spending, investment, right? So that was people's own businesses, like their capital gains. We talked about government purchases, and then we talked about our net exports, which were imports minus exports. Okay, so this is just kind of a reminder because talking about financial institutions and how we save our money is all part of how GDP is calculated. Okay, so it's all part of that process. Okay, so market for loanable funds. So this is where we talk about you guys as saving your money. So this is where we get into it a little bit more. Kind of explained it pretty good, I think. So I don't want to repeat myself and bore the heck out of you, but savers go through the market. So you guys wanting to save your money, you're going to go through, you're going to deposit your money into savings. Borrowers are then going to take that money out. So as saver, you're making money. As a borrower, you're paying money, right? And you paying money is because you're literally borrowing somebody else's savings. Okay, and that was what I said in the very beginning with that tricky little phrase. Okay, so then talking about loanable funds. So again, this is where now people are going to basically they're taking your savings and loaning it out to somebody else. The government gets involved here and handles the interest rates, especially for right now, what's going on with our crisis, to try to make sure that our GDP doesn't drop too low. Okay, some economists, as you know, feel that's a good thing, some do not. In the crisis we're in now, I can't imagine anyone that would say it's a bad thing what the government's doing to try to help out people with the crisis that they're going on. Okay, that's going on. Okay. So again, I said the government does set policies. They set policies for loanable funds that affects people's savings investments because they're trying to make sure that not only are individuals going to be successful, but so is our economy. Okay, so policy one talks about shelter some savings from taxation, so trying to lower the interest rate and save on taxes. So economists feel that people's standard of living depends on their ability to produce goods and services, right? So their savings determines how much is being produced. Because if people are saving money and not spending money, then not as much is getting produced. So here, if you raise the savings rate, there's more money for production, the GDP goes up, and there's a higher standard of living, right? So if you raise the savings rate, people are going to save money and they're going to spend a lot more money. Policy two is more of a tax incentive. So this is an investment tax incentive that gives tax advantages to firms. So basically this is saying to companies, if you want to build a new factory or if you want to buy some bigger equipment, we will help you. The government will help you by giving you a tax incentive. They'll give you a tax write-off so that you can do that and spend more of the money. Policy three is more of the government deficit. So we talk about a deficit, we talk about the government spending and how they spend more money than they have coming in, right? That's kind of what's going on right now. So the government will then have to borrow money, usually in a bond format, to make up for what they've borrowed. For what they've spent. Okay, and this talks about it here as well. So a surplus, if we have a surplus of tax, that means that the government is actually making more money than they're spending. And then they have to try to balance the budget.